The next question is explain capital asset pricing model and bifurcation of the total risk into systematic risk and unsystematic risk. That is the next question. So let us have understanding that say how to write answer for this question. So in short, we are going to have understanding of a new portfolio management theory, and the new portfolio management theory is CAPM. CAPM stands for Capital Asset Pricing Model. This is say one of the most successful portfolio management theory that we have. Let us have understanding of this say the portfolio management theory and what kind of the use that we have of this theory. That is what say we are going to discuss. First of all, we understand and say what kind of use that we have of this portfolio management theory. The term use that we have of this portfolio management theory is that you will be able to take a decision. Decision that you will be able to take is that whether to buy a security or not. You will be able to take a decision that whether you should continue to hold a security or not. You will be able to say draw a conclusion what should be the equilibrium price of the security. Like that, say you will be able to say take all these decisions that whether you should buy a security or not, whether you should hold a security which you already have purchased or not, what is the equilibrium price that you should be ready to pay for a security. In addition to that, say this will also help say even to companies say to decide the discounting rate at which say they should be expecting return from any of the expansion proposal, or if at all it is entering into new ventures and it is diversifying into new line of business. In that also, so the CAPM is going to be helpful. Initially, I am going to start with some very basic and the fundamental say the points in which say I would be focusing on the point that say the decision making about whether to buy a security or not, whether to hold a security or not. That is what say we are going to have say the initially discussion say about say the CAPM. Suppose that say you are considering say one of the security which is say listed on NASDAQ stock exchange to be purchased. A security which is say listed in the US stock market and you are considering to buy that stock. So should you invest in that stock or not? Say how can you take a decision? You know that say you are not very well conversant say with the United States market, but still can you take decision? Yes, with the help of the CAPM, so you can take decision regarding buying any stock anywhere in the world. I have never been to Japan, but still if at all say I am required to decide whether to purchase a security or not which is listed on Japanese stock exchange, can I take decision? Yes, through CAPM you can take decision. How can you take decision? So let us understand. CAPM says that say for the purpose of decision making, CAPM says that say for the purpose of decision making, you need to compute alpha of the security. What is alpha of the security? Alpha of the security is so the difference between the anticipated rate of return and so the required rate of return. Anticipated rate of return means so the rate at which you are anticipating, you are estimating that say how the security will perform. I hope you recall say the initial examples that say we have done, say like how that is what will be score of a player in a match, whether that is say the player will score like very high runs, very slow run, that is say very less runs, something like that. How can you make that estimation? You can have that estimation either based on the past performance of the player or based on say the anticipated future performance of the player. This is what say we understand is the way you make the computation of the estimated performance say of a player And exactly the same thing is applicable over here. In order to make an estimation that how a security is going to perform in future, either you take into account the past returns of the security or otherwise say the estimated future performance of the security. And that is what say we understand is the mean return that is required to be compared, or say from that the required rate of return will be deducted. Now what is the required rate of return? In a simple way, we understand that so the required rate of return means a return that an investor is expecting from the security based on the risk that investor is undertaking in an investment. In a simple way, we can say something like this. Suppose, for example, State Bank of India is offering the rate of interest of 6%. For example, State Bank of India is offering a return of 6%. Suppose, say there is a security, say called XYZ Limited. You are anticipating that the security is going to generate a return of 4%. In a normal market condition, we can say that this security is not worth purchasing. Why? Because the risk-free rate of return is 6%, and this security is going to give only 4% return. Why should I make investment in this security? I will not make investment in this security. Because we understand that say, if at all I make investment in this security, I will get a return which is less than the risk-free rate of return. This is what we understand. Okay. If at all there is another security, let us say ABC Limited security. Now this security is likely to generate, let us say, a return of 12%. Will you make investment in that security? We can say that say at least I will think that whether I should make investment in this security or not. Why? Because this security is able to give a return which is more than risk-free rate of return. But at the same time, I would like to check that what kind of risk that the security has. Based on the risk, I will compute that what is the rate at which I require the return from the security. As I have provided to you, that say you are anticipating that the security is likely to generate a return of 12%. The return from the security based on the risk is, for example, return expected from the security based on the risk is, let us say, 14%. Then in that case we understand alpha of the security is negative and you should not buy the security. If at all, say you are anticipating that the security will give a return of 12% and based on the risk, the security should generate a return of 9%. Then in that case, alpha is positive, and since alpha is positive, you should buy security. This is the way, so you can take a decision with respect to purchasing or holding of a security. So we understand that say over here that say you are required to make the computation of the required rate of return from the security, and based on that say you will be able to take the decision. This is what the CAPM says. As far as the calculation of the mean return is concerned, for that say whatever the things that say we already have studied, all those things are applicable over here once again. Either you take past or you take the predicted future. Coming back to the point, say how to compute the required rate of return say from the security. By applying common sense, we understand that say generally the required rate of return would be exceeding the risk-free rate of return. Why? Because we understand that say as far as the risk-free security is concerned, it does not have a risk. If at all I make investment in a security where there is an element of risk, I would be having so the required rate of return say exceeding the risk-free rate of return. Now CAPM says that say we are measuring the risk in form of beta of the security. So far friends, we have understood that's the measurement of the risk in terms of the standard deviation of the security. But now onwards, we are going to understand in CAPM, like the theory, measurement of the risk in form of so the beta of the investment. Now, how do you compute the beta and what does beta indicate? That is what now we are going to have a discussion. Importantly, friends, CAPM is bifurcating the total risk of any security into two parts. CAPM is bifurcating the total risk of a security into two parts. One is given a name as systematic risk and another is given a name as unsystematic risk. So the total risk as per CAPM is divided into two parts, systematic risk and unsystematic risk. What do we understand with the term systematic risk? As the name suggests, this is the risk which is there in the system itself. So what happens that in spite of the best diversification of the portfolio, in spite of the best analysis that you have made and you have made investment in the portfolio, still this portion of the risk cannot be reduced or it cannot be eliminated from the portfolio. That is what we understand is called systematic risk. The examples of the systematic risk are: 1. Inflation. Second, a situation of war. Third, a situation wherein the exchange rate fluctuation. If at all there is a situation that there is the change in government. Next, the change in Reserve Bank of India policy. Of course, you can understand that looking to these examples that these are the things which are not under control of any one company. Understand, friends, that basically an investor is making investment in a company. Now, whatever the investment which an investor is making in a company, now whatever the return that the company is able to earn from the market, whatever the return that the company is able to earn from the market, that itself is a return which the company will be able to give to the investor. Now you can very well understand that these are the factors because of which there are definitely the chances that the return of the company will be affected. If at all the return to the company will be affected, in turn return to the investor will also be affected. If at all a company is exporting goods in dollar currency and suppose because of some reason dollar currency depreciates, or we know that recently that the United Kingdom has taken divorce from the EU, European Union. In that case, that is pound currency has depreciated a lot, and it has reached to a point that to which it has not reached over the last 40 years. So we understand that if at all I am exporting in a currency that is pound currency, then return of my company will be affected. In that case, return to the investor will also be affected. If at all there is a situation of war in the country, then in that case, nobody has a business. If at all none of the company has a business, then in that case, how investor will be able to get the return? Recently, we have seen a situation of COVID-19. COVID-19 was a situation, again, it was not under control. If at all I have made investment in a travel company and the travel company in which I have made investment is not able to generate the return, then of course it is not because of the mismanagement of the company, but it is because of the market forces. So due to external environment, if at all a company is not able to generate the return, and in turn investor is also not able to get the return, is given a technical name as systematic risk. The term systematic risk means the risk which is there in the system itself, and in spite of the best diversification, in spite of the best the analysis, so you will not be able to generate say a huge return on your investment. So friends, CAPM says that, say, we understand that, say, this is the risk to which an investor is exposed to, because, say, this is the market risk. This is not, say, something which is under control of any company, and since the company is exposed to that kind of risk, even the investor is also exposed to that kind of risk. However, as far as the unsystematic risk is concerned, unsystematic risk means the risk which is, say, a company oriented risk. It is not, say, something which is, say, the industry oriented risk, or like the all the companies are, say, facing that kind of risk. For example, if at all there is a situation that management of the company does not have, say, the good relationship, say, with its laborer, management of the company, say, does not have good relationship with its laborer, in that case we understand it is considered to be the unsystematic risk. It means that, say, as an investor you should avoid making investment in this kind of security. It may happen that, say, the management of the company is, say, already criticized, say, in the media, say, for having malafide intention. If at all you make investment in that kind of security, even like after going through all this news, then in that case it is your foolishness and you should not make investment, say, in such kind of security. We understand that, say, as an investor, so you should not make investment in securities which have positive relationship. You should make investment in securities which have preferably negative relationship, or at least, so, the lower positive relationship. That is what's the combination in which you should make investment. In short, say, by using your, say, the portfolio management techniques, whatever the risk that you can avoid, or whatever, say, the like the securities that, say, you can avoid investing, otherwise unnecessarily you will invite the risk, so that is considered to be the unsystematic risk. CAPM says that we believe that, say, we are working for a smart investor. We believe that, say, we are working for an informed investor. That is the reason, say, we will not take into account unsystematic risk for the purpose of determining the required rate of return, say, from the security. We assume that the investor has properly diversified portfolio and investor is able to eliminate the unsystematic risk. In short, so the investor would be exposed only to, say, systematic risk. So here, so the risk is measured in form of beta, and the beta measures only systematic risk. How to calculate the systematic risk, that we are going to see later on. But for the time being, we understand that the CAPM says that, say, we believe that, we agree that the investor is taking risk when he is investing in a security or a portfolio, but that is only the systematic risk and not unsystematic risk. And this systematic risk we will measure in form of beta of the investment. That is what we understand. How to calculate the same, that we are going to understand slightly later on, and using the beta as a measurement of the risk, how to make the computation of this required rate of return, that I am going to discuss, say, in just time to come. So write down heading CAPM, capital asset pricing model. In that, write down first point, CAPM is a portfolio management theory comma, it helps an investor A to decide whether to buy slash hold a security. B. What is the equilibrium price that an investor is ready to pay for security? Second point, CAPM also helps a company to decide about a discounting rate for expansion and diversification of new line of business. Full stop. Heading right down, decision making based on CAPM. In that write down, in order to decide whether to buy slash hold a security, comma, we need to find alpha of the security. Alpha of security. Full stop. Formula for alpha is x bar minus RR. X bar is anticipated rate of return. RR is required rate of return of security. Full stop. Alpha is, I'm sorry, X bar is calculated either using past performance or using future anticipated return of security. Full stop. RR, in bracket I'm writing required rate of return is found based on risk of security, comma, measured in form of beta of the security. Full stop. Generally, required return is more than risk-free rate of return. Full stop. Now, new heading write down risk. In that write down first point, as per CAPM, total risk is bifurcated into A, systematic risk, and B, unsystematic risk. Second point, systematic risk means that portion of total risk which cannot be reduced with proper investigation of security or proper diversification of portfolio. Full stop. We understand that there are certain factors which are not under control of a company and due to that return of company is adversely influenced. Full stop. With that, return to investor is also adversely influenced. Full stop. Examples: one, war; second, inflation; third, population; fourth, exchange rate fluctuation; fifth, COVID 19; sixth, change in government or government policy or Reserve Bank of India policy. Full stop. With paragraph write down. Such other factors which are not under control of the company. Full stop. Third point, other component of risk is called unsystematic risk. Full stop. It means that portion of risk which can be eliminated with proper selection of securities or combination of securities. Full stop. Fourth one, importantly, CAPM believes that an investor has completely nullified unsystematic risk. Full stop. Examples: 1. A company not having good public image. Second, a company not having good relationship with its laborers. With paragraph write down, and such other factors which are related to the company full stop. So here is the diagram. The diagram is prepared in this way. On x-axis I am taking diversification, that is an independent factor, and on y-axis I am taking risk of portfolio. When diversification is very poor, then in that case we can see that the total risk of the portfolio is very high. This is the total risk of the portfolio. With the good diversification, we understand that so the total risk of the portfolio reduces and you are able to say eliminate the unsystematic risk. After good diversification, say you are having say only systematic risk in the portfolio. You can see that say if at all you are having say further diversification, even with that say the total risk of the portfolio is not reduced. Beyond this point you can see the diversification does not give advantage to you and you are having say some minimum level of the risk in the portfolio, and that is what say we understand is the systematic risk of the portfolio. Please draw this diagram. Friends, as far as this systematic risk is concerned, systematic risk is having a certain different name also. Systematic risk is also given a name as say the market risk. It is also given a name as say the undiversifiable risk. It is also given a name as say the explained risk. That is what say the systematic risk is given a name. And as far as unsystematic risk is concerned, it is also given a name as unique risk. It is also given a name as diversifiable risk. It is also given a name as unexplained risk. That is a way so it has been given certain different names like this. So of a small summary of the entire answer, in that is initially I have dictated to you, let's say what is the use of the CAPM. use of the CAPM is that it will be able to help us to decide that whether to buy a security or not. If at all we already have purchased a security, then we should continue to hold that security or not. Further, say it will also help us to determine the equilibrium price of the security. Later on, we are going to understand, say it helps us to decide the discounting rate. Yes, the cost of capital. If at all we are going to expand our existing business, or if at all we are entering into a new line of business, then in that case, how to determine the discounting rate. For the purpose of decision making, say a Greek letter, so the alpha is required to be calculated. It is found as the difference between the anticipated rate of return and the required rate of return. Anticipated rate of return is calculated using the past information or expected future information. The required rate of return is calculated using the risk-free rate of return and the risk, which is measured in form of beta of the investment, and the beta measures only the systematic risk. So as far as the risk is concerned, the risk is divided into two parts. One is given a name as systematic risk and another is given a name as unsystematic risk. See, the term systematic means which is there in the system itself, and unsystematic means we understand that it is not there in the system. It is unique. It is applicable to a company only. That is the reason it is called unsystematic, or we understand it is diversifiable, because with the proper diversification you can eliminate that risk. Not only you are able to reduce it, but with the proper diversification you are able to eliminate it. So systematic risk is that portion of the total risk which cannot be reduced with the best diversification. These are the factors which are not under control of the company. It is outside the control of the company. We understand that considering the market changes, the companies are exposed to certain kind of risk, and in turn investors is also exposed to that kind of risk. For that, the best examples are war, inflation, population of the country, exchange rate fluctuation, COVID-19, change in the government policy, change in the government, or change in the Reserve Bank of India policy. Dear students, in your risk management chapter, you have studied all these, the risk aspect, in which the currency risk you have understood, interest rate risk that you have understood. All those are the best examples that fall under the category of the systematic risk. And in spite of the best the things that you have done, you are always exposed to that kind of risk. Such other factors which are not under control of the company. Other component of the risk is unsystematic risk. We understand that with the proper planning you can definitely eliminate them. You should not invest in securities which have positive relationship. You should not invest in a company which has some internal problems. You should not invest in a company which does not have a good public image. That is what we understand. So we understand that with the proper diversification of the portfolio, you will be able to eliminate the unsystematic risk, and you are left with only systematic risk of the investment. This is what we understand is the application of the CAPM. Certain other names are provided to the CAPM like this.